Hello, First Quantum Leader, and welcome to the fourth unit of understanding the elements of the balance sheet. Today we'll be looking at the last section of the balance sheet, the non-current assets. In the last unit, your task was to identify the payment terms for 5 suppliers. How did you get on? The later the payment terms for your suppliers, the better the cash flow for First Quantum. In the first unit, we looked at an overview of the balance sheet, and in the second unit, we examined where capital comes from, debt and equity, which appear as non-current liabilities and equity in the balance sheet. And in the third unit, we examined one of the applications of that capital being working capital. The working capital is the current assets less or net of the current liabilities, also known as the net current assets. In this fourth unit, we'll be looking at the last section of the balance sheet, the non-current assets. At the end of this unit, I'm going to ask you to, in the next week, identify an asset that is no longer fit for purpose and whether it should be repaired or you should replace it. As we discussed in the first unit, the non-current assets are the things that we own, assets that we need to run the business. By far the biggest number in this section is the property, plant and equipment, sometimes referred to as PPE. This probably makes sense for First Quantum. We need lots of machinery, diggers, conveyor belts and all manner of other assets with which we use to extract the minerals from our mines. The PPE for First Quantum is almost $20 billion, which is an FBN in itself. Note 6 to the accounts provides us with a breakdown of the $20 billion of PPE. We don't need to know what every number means, but it's worth noting the following points. 1. There are 4 main categories of PPE. These are A. Plant and equipment of $10.8 billion. B. Mines being set up, capital work in progress of $851 million. C. Operating mines of $7.2 billion, and D, development projects looking for new mines of $1.1 billion. 2. Items are constantly being added to each category, i.e. the purchase of a new asset, and removed from each category, the sale of an asset that is no longer required. 3. Items are also transferred between categories. Hence, development projects looking for new mining opportunities will become capital work in progress, setting up a new mine, which in turn will become an operating mine. At these mines will be plant and equipment, such as diggers, etc. You may have noticed at the top of the page that this says it is a consolidated balance sheet. This means that it shows all of the various companies that First Quantum owns, known as the group of companies. Where First Quantum only owns 50% of another company, such as KPMC, then this is shown as an investment in a joint venture. Where First Quantum owns less than 50% in another company, this will be classified under other investments. You'll also see a line called Goodwill in the non-current assets section. Goodwill arises when First Quantum buys another company. Companies such as First Quantum can either grow organically by finding new sites to mine and setting up operations, or by buying existing companies that have already been set up. Typically, for a company such as First Quantum, growth will be achieved through a combination of both strategies, organic growth and acquisition. When First Quantum buys another company, they're buying all of the assets and all of the liabilities of that company. In effect, they're buying the net assets of the business. However, what they're actually buying is the future earning potential of the company. Thus, the purchase price of the company being bought is usually higher than the net asset value. This difference is known as goodwill. Let's consider that thought for a minute. When First Quantum buys a company, it gets the net assets of the company, i.e. the assets and the liabilities. But what it is actually buying is the future income that that company can potentially generate. We can apply this concept to the purchase of individual assets. For example, imagine that you own a shovel and can mine a mineral in the loosest sense of the word and generate $1,000 profit per year. I then offer you a digger to make your mining easier, and you reckon you can now generate $11,000 per year of profit. Would you pay $50,000 for the digger? This is where the finance guys would use a technique called discounted cash flow, because money earned in the future is not worth the same as money earned today, to calculate the net present value of the future cash flows. In our example, you are, in effect, paying $50,000 today for an increase in profit of $10,000 per year forever. The digger will have paid for itself in 5 years, so if it has an expected life of 20 years, then this looks like a good investment. And where would you get the money from to buy the new digger? Debt and or equity, of course. So the aim is to ensure that the return on your investment, the ROI, which is the profit generated by your assets in which you have invested, exceeds the cost of capital, that is, the cost of the debt and the equity. So the non-current assets are things that we own that we use to run the business. For First Quantum, this will mainly consist of all the plant and machinery which we use to run our mining operations. So on to your task for today. In the next week, identify an asset that is no longer fit for purpose and consider whether it is better to repair it or to replace it. In the next unit, we'll be looking at the accounting concepts of depreciation and amortization. Looking forward to seeing you then.